Hi, I'm Jimmy. In this video, we're looking at the US economy. We're trying to answer the question, should we invest now or wait for the stock market to fall, let's say a bit more than it already has? As we can see, this is a 3-month chart of the S&P 500. The stock market's down a decent amount. So we're going to look at different economic indicators to see where the broader economy stands. And then we're going to try to forecast where, use some leading economic indicators to see whether or not it makes sense to invest now or wait. That being said, let's jump into our first economic indicator, which is a very important one, which is consumer confidence. Consumer confidence is so important because it's the consumer that drives the US economy. And ultimately, that's what this economic indicator is trying to measure. It's trying to measure how confident consumers are in their broader where they believe the economy is, job security, things like that. And as we could see, this economic indicator is at the lowest level it's been in a long time. This is a 20 some odd year chart. And notice in here, we have the financial crisis, the Great Recession back in 2008, 2009. And currently the consumer confidence is down near those levels. So this is clearly a bad sign. And when we jump over to our economic scorecard, well, we can see that this point is clearly going to go to the bears. Okay, now let's jump over and look at inflation and wage growth. Now, this is important because, and I combine these two because the two really belong together. So, for example, back a couple of years ago after COVID happened, well, inflation went really high and wage growth didn't get up that high, which means it was costing. It's a bad sign for the economy. The Federal Reserve had to increase interest rates, and ultimately, wages were growing at a slower rate than costs were. So that clearly is a bad sign for the economy and will slow down the consumer. Again, that's a bad thing. Now, the problem with this economic indicator is that it's a backwards looking economic indicator. It takes time for things to kick in. So with all the tariffs that are happening and with talks about whether or not it'll increase prices, well, that'll take a little bit of time to sort of run those through the numbers. This time next year, we'll have an idea as to whether or not it actually is a bad sign and whether or not these numbers actually get worse. But for now, wage growth is still up there relative to inflation, and inflation remains, well, it's back to a relatively low level. So from an economic scorecard standpoint, I think we got to give both of these points to the bulls. Now, I'm going to kind of blaze through a lot of these economic indicators so we can get to the meat of the question of, do we invest now or wait? Because again, we saw how down the stock market actually is. And I'm going to refine this list after I go through a few. Okay, now we've got another lagging economic indicator, but an important one to include, and that is unemployment. Now, this one we can see on a long-term basis, unemployment actually looks fairly low. And it has been drifting up slightly recently. And again, whether or not the tariffs that are happening right now will ultimately have an impact, either positively or negatively. There's arguments being made on both sides of that coin. That will take a bit of time before those actually hit the numbers. So for now, I'm going to kind of take the easy way out here and say, yes, it's low. It is drifting a little bit higher, but just to avoid it tilting the scales too much in one direction, for now, we're going to tilt them later. Don't worry. But for now, I'm just going to go neutral with these points. 1 point for the bulls, 1 point for the bears. Okay, now we're going to jump over to a leading economic indicator, and this one's been important for a very long time and continues to be important, and that is the U.S. Treasury yield curve. So they say an inverted yield curve has preceded every recession in the U.S., and for a long time, the yield curve was inverted, basically pointing down. The left side of this chart should be way lower. It should be upward sloping. An upward sloping yield curve is what we want. We sort of got a U here. Now, just to clarify this a bit, two of the most popular time periods to look at would be to compare the 3-month treasury to the 10-year treasury. And we can see if we use that, well, this yield curve is in fact inverted. And this is a bad sign from will a recession come? Now, from a reliability standpoint, this is the most important yield curve. This is the one that the New York Federal Reserve uses. This is historically the most predictive economic indicator as far as the yield curve is concerned. This is the most important combination. Now, interestingly, if you look at a lot of news articles or, headlines, well, they tend to use the 2-year versus the 10-year. And in that case, the yield curve is in fact, is properly sloping. It is an upward sloping yield curve, which is a good sign. But from a scorecard standpoint, I think we got to lean on the most reliable one, which is the 3-month versus the 10-year. And if that's the case, when we jump back to the scorecard, I think it makes sense to give this point to the bears, even though the 2-year versus the 10-year is in fact upward sloping. But the downward sloping nature of the short-term yield curve, as the 3-month over the 10-year, I think is more reliable and more valuable and something we have to pay closer attention to, because this has the potential to hurt the economy. Now, if we're curious why this would hurt the economy, if you think about the banking industry, the bank borrows money at short-term rates, right? They borrow money at short-term rates, they lend it out at long-term rates. Think the money you might buy in a CD, you might put into a CD or maybe in your checking account or savings account. That is them borrowing money at a short-term rate. Then they lend that money out for, let's say, a 30-year mortgage. Well, that is a long-term rate. So if that is inverted, if the short-term rates are higher than the long-term rates, in theory, the bank will be losing money. What do they do if they lose money? They stop lending, or at least they slow lending. Slower lending equals a slower economy. That's the reason this could be a problem. Okay, now let's jump over and look at housing. So for the economic indicator here, I'm going to use housing starts. Now, we can see housing starts. This is the number of new houses being built. And, well, the number it was sloping up for many years. This is a long-term chart, and recently has pulled back. Now, it's kind of zigzagged on its way down as it has pulled back. It's kind of on the higher end right now. Is this a positive sign? Is this a negative sign? I think that this one's kind of in the middle from a, how the housing market looks currently at this point using that economic indicator. So with that being said, I think it makes sense to give this point to 1 point to the bull, 1 point to the bears. This goes neutral. This is our final neutral point. We got a few more coming up. Okay, next up, we've got ISM manufacturing. And this economic indicator looks at how the manufacturing sector in general is doing. And this one's fairly simple to read. 50 is the key level. Anything above 50 implies positive growth. Anything below 50 implies negative growth. Right now, it's just below 50. Now, again, we'll see over the long run how tariffs affect this economic indicator one way or the other. But for now, it is below 50, which implies negative growth in the manufacturing sector. So for now, we got to give this point to the bears. Okay, now we've got two different economic indicators that are kind of combined into one, but I think they're both lagging economic indicators, so they're backwards looking. But they're interesting if we're looking at the health of the US consumer, and this is 90 days late on credit cards. And we can see the number right now is fairly high up there. This is clearly a bad sign. Now, right kind of in line with this, and as you might expect with one being up, well, 90 days late on auto loans is also up near historic highs. Again, this is a long-term chart. So clearly, when we look at, let's call it the debt of a consumer, just debt in general, this is a bad sign because people being late on their credit cards and auto loans, this is the beginning of a problem potentially. Now, it's been up there before, so, and it's a lagging economic indicator. We'll see where things go. But for now, it's not looking all that great. Okay, now, this is a lot of the key ones. We got another one that is arguably more important. But just to narrow down this list a little, if we're curious, these are the leading economic indicators. So with everything we just had, these are the ones that are supposed to be most predictive of where the US economy is going. Now, with that being said, another economic indicator, if you want to call it that, and really shouldn't be ignored, is ultimately the stock market. The S&P 500, or the stock market in general, I'm using the S&P 500 to be representative of the stock market, but in all cases, this is a 3-month chart, it's down. The S&P 500 is a very forward-looking entity, if you want to call it that. I don't know. Forward-looking indicator, if you want to call it that. Either way, this being down, I mean, if we were going to give this a score from an economic scorecard standpoint, clearly you got to give this point to the bears from the stock market perspective because this is a problem. Now, that brings us back to the question of, do we invest now or do we wait for the stock market to fall more? And this is actually a really tricky one to answer. And I think a lot of it depends on each of our own perspectives and our own, call it the sleep test. If you bought a stock here, if you bought an investment here, an ETF, a stock, whatever it is, if you made an investment here and it kept falling, could you sleep at night? Some people prefer it to fall and then start to recover before they jump in and buy it. I don't necessarily mind buying when it pulls back, partially because if I'm buying companies, especially in a time like this, and I'm looking to buy companies like this, especially companies that have higher profit margins, because it looks like we might be, based on the economic indicators that we saw, it looks like we might be heading into a recession. And the stock market's telling that. A lot of the leading economic indicators are telling us that. But here's my thought process. If I buy high quality companies that look like they're on sale now, companies that in theory have relatively strong profit margins, somewhat of a moat around their business, well, if it continues to fall, I can average down. Now, interestingly, in a recent video I did, somebody had put up a comment saying that a lot of people have been burnt buying when the stock market's falling. And I would argue that more people get burnt selling when the stock market is falling. You know, there are many people that see this red, freak out, and sell down here. And don't forget it, just a couple years ago, if you go back to 2022, we had a similar situation like this. And I know I bought a lot of my holdings in my current portfolio. I bought in 2022 when things were falling. Now, this fall right here, as you can see on this chart, this is a 5-year chart. This fall is a bit more abrupt than it was back in 2022, but things are trending lower. The Mag 7 were down. The S&P 500 was down. The NASDAQ was getting killed. There were a lot of companies doing bad. And I don't think for any of the companies I bought at the low. I bought them as they were falling. And if they kept falling, I averaged down in some cases. But over the long run, even with the pullback, I'm still way up in the portfolio. I'm still doing fairly well. I've outperformed the S&P 500 since 2022, since that pullback happened, because I was fortunate enough to buy when things pulled back. But again, I think a lot of that comes down to the sleep test. Are you comfortable with buying, watching the numbers go red for a while, knowing that what you bought was a good company? If you buy a good company and hold it for the long run, that is ultimately likely to serve us very well. If you're not comfortable with that, simply wait. I wouldn't recommend to anybody to jump in and buy something that they're not comfortable with, trying to time the bottom. That's not the point. I'm looking for companies that look undervalued. I have no idea where the bottom is. Nobody knows where the bottom is. So if that's the case, I might as well try to find companies that are undervalued. If they are, buy them. If they become more on sale later, I'll try to buy more later. But that's ultimately my opinion. My opinion is, option 2, dollar cost average. If you happen to be dollar cost averaging, this is a fantastic position to be in. Many people have said dollar cost averaging is better than picking individual stocks. And you're probably correct. Many people have proven just buy SPY or VOO or QQQ, whatever investments you're interested in, just buy the ETF, sit and hold. And if you dollar cost average, well, right now you'd be buying more shares because the prices would be cheaper. So that could be a fantastic thing to do. Now, if you happen to like researching stocks, I actually did a video called 8 Steps to Analyze a Stock. And if you'd like to sign up to get access to the Investors Grow website, where we have all these charts to help try to make it quick and easy to analyze companies and try to find undervalued companies, well, I will leave a link right here, link in the description below for both of those. Thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.